Thank you very much, and thank you all for sticking around to the afternoon session. My name is Kate Wilson. I'm Research Director for Australia and New Zealand at RFI Group. I know a few of you in the room already work with RFI Group. For those of you who don't, we're a global provider of market and business intelligence to the financial services community. And basically what that means is we perform a number of research programs across 44 markets globally, talking to consumers and to SMEs and corporates about their banking behaviours and their banking needs. So what I wanted to take you through today was some of our recent research findings around what we're seeing in the payment space, specifically in New Zealand, but also looking at how that compares to other markets globally. So we're drawing on here results from our New Zealand Payments Program, which is a survey of 2,000 consumers, nationally representative of the New Zealand market, as well as our Global Digital Banking Survey, which is 1,000 consumers in 10 different markets around the world. And again, nationally representative with the exception of China and India, where we're talking to the banked urban population. I'm actually picking up on some of the themes that Paul was just talking about, but putting some data behind them, so hopefully still interesting. So firstly, looking at the global payment trends that we're seeing, so the decline of cash being sort of a key one, as well as the rise of contactless payments and also mobile payments. Then moving on to disruption in payments. So the rise of buy now, pay later services like Afterpay have started to have an impact on online payments in New Zealand, as well as in Australia, although not technically payment providers. And then because open banking has been such a topic of interest, not only across the conference, but for all of our clients globally at the moment, I've also included some slides around what we're seeing in terms of learnings from open banking in the UK. So drawing here on a study that we just did in the UK around consumer perceptions of open banking as well as PSD2. So firstly, looking at some of those key payment trends, how does New Zealand compare to other markets globally? And I firstly wanted to touch on the decline of cash. So what we're seeing is that cash is declining at a global level. Yesterday we heard from RBNZ who was saying that we still see cash being used in the New Zealand economy, and our research supports that as well. What we see is that if we look at the proportion of consumers who use cash in a typical month or in a year, we're not really seeing any sort of significant declines. What we are seeing though is consumers changing the way they use cash. And probably the best example of that is when we ask consumers what their payment preference is across different payment scenarios, we're really starting to see a decline away from cash towards, in particular, debit card payments. And the most important one there is low value payments. So low value payments is sort of the only real remaining payment scenario in New Zealand, as well as in some other developed markets like Australia and the UK and Canada, where consumers prefer cash over other payment methods. But that is declining, and that's declining partly because of debit cards, but also importantly because of contactless payments. On this slide, we're looking at the proportion of consumers who can envisage a cashless society. So not necessarily having no cash, but being able to make all payments necessary in a payment method other than cash. Globally, 42% of consumers can now envisage not having to use cash as a payment method. New Zealand's ahead here and also ahead of Australia, so that Kiwi versus Australian comparison that we've been talking about today. New Zealand ahead here, so 45% of consumers in New Zealand can envisage a society where they don't need to use cash. That's ahead of most developed markets. I'll come on to developing markets a bit later on, but some of this was already touched upon by Paul as well. So China, Mexico, and India are the three markets where we see the highest proportion of consumers saying that they can envisage not having to use cash anymore. A lot of that has got to do with that rapid digitization and the mobile payments that we're starting to see coming through in China and India in particular. The other point I started to make was around contactless card usage. So contactless card usage, in particular contactless debit cards, are starting to help move that shift away from cash. Because contactless payments are so quick and so easy, they make it's a better payment experience for consumers compared to paying with cash. Looking here at the proportion of consumers who've used contactless across different markets, and we're seeing significant increases over the last couple of years in some key markets, including New Zealand. Also in the UK and Canada, we're starting to see really rapid increases in contactless card usage. New Zealand's also amongst one of the greatest users of contactless cards across all of these markets. Australia does lead New Zealand here, So for Australia, we see 74% of consumers using a contactless card. And probably a key point there is that's starting to plateau. So we're starting to see the proportion of Australians who use contactless cards sitting around that 74% mark and not really moving significantly over the last 12 months, which does suggest that there is room to grow in New Zealand when we're looking at contactless card usage. So what we're looking at here in the blue line is the proportion of consumers in New Zealand who've used a contactless card. The dotted line is the adoption curve in Australia. So from that sort of 50% mark, what did it look like going forward? You can see that the lines are sort of similar. So the adoption curve is quite similar in both markets. We actually did this same exercise for the UK, and we saw the same thing there as well, that the UK adoption curve was quite similar to the Australian adoption curve once you got to that sort of 50% mark. So what that means is if contactless adoption in New Zealand continues to follow that same adoption curve, we'll see about 75% of consumers here using contactless cards in the next year. That doesn't mean that there are different reasons why people use contactless cards. So the key drivers of usage of contactless are convenience and ease. When we've looked at the extent to which security plays into that, security is always perceived as being sort of the key barrier to contactless card usage. But actually consumers who use contactless cards, to an extent, still perceive contactless cards as being unsecure. But once you get that sort of, once they believe that it's easy to use, that it's convenient, that it's faster, the security doesn't play as big a role in terms of stopping people from using contactless. The other part here, of course, is acceptance. So what we see is that acceptance is important in terms of getting people to trial contactless usage. Once they start trialing it, the convenience and the ease take over. But acceptance is also really important to driving frequent contactless usage. So unless you can have consumers using contactless weekly, but ideally daily, you're not going to see it sort of transitioning into being their primary payment method. In Australia, the rollout of contactless at supermarkets really helped to push on contactless payments. In the UK, being able to pay for public transport in London was a key driver of contactless card usage there. So getting that daily payment behaviour, or at least weekly payment behaviour. So cash is declining. We're continuing to see an increase in contactless card usage, but that's probably going to plateau. So what's next for payments in New Zealand, and specifically for in-store or in-person payments? We're also tracking mobile wallet usage across different markets. These are results for New Zealand, looking at the proportion of consumers who are aware of the different mobile wallet providers. Over the last 12 months, we've seen significant increases in awareness for both Apple Pay and Android Pay. So in New Zealand, 53% of consumers are now aware of Apple Pay. Again, quite similar to other developed markets, so similar to Australia, the UK, and Canada. But are people using mobile wallets? And the answer is generally no. So in New Zealand, just 4% of consumers say that they've used Apple Pay. 1% say they've used Android Pay. Which doesn't sort of suggest that these are going to take off anytime soon. And also suggests perhaps that there is not the sort of same drivers of mobile wallet usage as we saw for contactless card usage. Whenever I present this slide, I get asked, is the reason why mobile payment usage is low in New Zealand, is that because not all of the banks offer Apple Pay or Android Pay? If we look at other markets, we see mobile wallet usage is low across almost all of them. The exception here is obviously China, which I'll come on to. But if you look at a market like the UK, where Apple Pay is available with all of the major banks, 7% of consumers have used Apple Pay, compared to 4% in New Zealand. So access to Apple Pay isn't the only thing that is stopping mobile wallet usage. Actually, if you look at the results for London, you see closer to 15 up towards 20% usage of Apple Pay, which goes back to, as I said before, you can use contactless cards or an NFC mobile wallet for public transport in London. Public transport, in my opinion, is probably one of the only payment scenarios where paying with your phone actually gives you an advantage over paying with a plastic card. It's generally already in your hand. You don't have to worry about, for me personally, going through your handbag, trying to pull out your wallet, finding the right card, and then tapping off. If we see public transport going open loop, perhaps that's an example of where mobile payments might fit in to in-store payments. But sort of globally, we're sort of seeing them stall a little bit. China and also India, which isn't on this slide, are sort of the two markets where we do see mobile payment usage taking off. According to RFI data, amongst banked urban Chinese, 90% have used a mobile wallet. 89% have used Alipay. So massive figures. In those markets, as Paul was touching on, they've moved almost directly from cash to mobile payments. They haven't gone through going from cash to contactless cards to mobile payments, so they're leapfrogging. Also an example of where a mobile payment actually provides something new and different that they can't actually get from either from their bank or from traditional payment services providers. And the QR codes are key there as well, so not having to have to use a contactless enabled terminal. Which brings me on to the role that contactless plays as being a barrier to mobile wallet usage. So a few years ago, when we were starting to talk about Apple Pay and Android Pay coming out into the market, what we thought might happen was that contactless cards would be a stepping stone to mobile wallets. So once you're familiar or comfortable with paying by tapping your card, then swapping out a card for a phone seems like an easy step. Actually, the markets where contactless usage is highest see the lowest rates of appeal for mobile wallets. So on this slide, along the horizontal, we're looking at the proportion of the population who use contactless cards. Along the vertical, we're looking at the proportion of the population who find mobile wallets appealing. So Mexico, India, China are the three markets where we see high rates of appeal for mobile wallets. Less than 30% of the population use contactless cards. In markets like New Zealand, but as well UK, Canada, Australia, Hong Kong and Singapore, high rates of contactless card usage, very low rates of appeal of mobile wallets. Mobile wallets don't actually provide consumers with anything additional to what they're currently getting from their contactless cards. And that's what we've seen coming through in our research quite consistently over the last couple of years. To a consumer, paying with your phone doesn't offer anything over paying with a contactless card. It's not really solving any pain points, which suggests that we're not really going to see any of those numbers changing in terms of mobile wallet usage, at least in New Zealand, in the next few years. Is there anything that could be done in order to drive mobile wallet usage? In New Zealand, we asked consumers, which of the following features would encourage you to use a mobile wallet? 50% said the ability to store and scan loyalty cards within their wallet. 42% said the ability to store electronic receipts or invoices within their wallet. I thought, interestingly, given the sort of conversation we've been having about digital identity, being able to store your driver's license in your mobile wallet comes in third. So for a mobile wallet to actually take off in the market, it needs to do more than just provide the same payment experience as a contactless card. It needs to actually replace a wallet. Personally, I'm a big Apple Pay user, but I do realize that when I'm paying for something like a taxi, I pay with my phone and then take the receipt and put it into my wallet. And I also have to carry my ID around with me a lot, often in my hand along with my phone. So being able to solve that for consumers perhaps would create a situation where we see mobile wallets taking off to a greater extent. Next, I want to talk a bit about disruption in payments. So when I created this deck, I called this Online Payments and the Rise of Buy Now, Pay Later. But actually what I'm talking about here is just disruption in payments, and where I think there's still potential for disruption in payments is in the online space. So while there are still some pain points in the in-store process of making a payment, it's not really around that sort of speed and ease which contactless cards are already meeting pretty successfully. But there's still plenty of friction when it comes to online payments. Globally, we've been tracking the proportion of consumers who'd be comfortable using a digital-only provider across different banking products. Consumers will be most comfortable using a digital-only provider for payments compared to other banking products, followed by savings. Borrowing's probably a little bit misleading here. If we'd broken out mortgages from credit cards and personal loans, mortgages would be a lot lower in terms of comfort with digital-only providers. But payments is really the area where consumers already see some advantage in using digital-only providers and don't necessarily need that face-to-face interaction. And largely that's because consumers understand how a payment works. They understand how a credit card works as well. They don't feel the need to talk to someone about that product. This is the global average. When we look at this for New Zealand, New Zealand's a lot lower across each of those different products in terms of the proportion of consumers who'd be comfortable using a digital-only provider. We also ask a question around comfort with fintechs. Out of all of those 10 markets, 11 markets that I showed you before, New Zealand has the lowest rate of comfort with fintech providers as well as being uncomfortable with digital only. New Zealand also has the highest rate of digital banking usage of all of those markets, followed sort of closely by Australia, or just behind. But what that says to me is it's similar to that sort of graph with the contactless cards and mobile payments, is that if you're providing a good digital banking service from a digital provider, there isn't a lot of room for fintechs to come in and disrupt. But that could all change quite quickly as we see more fintechs coming into the market, as we see open banking coming into the market, as we start to see fintechs providing different types of services. Which is why I wanted to talk about buy now, pay later. As I said, not technically payments, but it is changing the way people pay online. We've been tracking this over time, so I'll show you the trend in a moment, but looking at the extent to which consumers in New Zealand are, one, aware of different buy now, pay later services in the blue, and in the orange, the proportion who have used one of these buy now, pay later services. And almost all of this is online, so only a small proportion are using any of these services in store. Afterpay and lay-by are really leading the pack in New Zealand. 28% awareness of Afterpay, 24% awareness of lay-by. The conversion rate between awareness and usage across almost all of those providers is around 30%, and that's remained consistent over the last 12 months. So as awareness continues to increase, you'd expect that usage will also increase in line with that. When we look at who is using these services, overwhelmingly it's millennials. Partly that has to do with who the merchants, these payment providers, the buy now, pay later service providers are partnering with. But gives you also an idea of perhaps the reasons why people are using them, which I'll come on to a little bit more in a moment. But people who are using these services tend not to have credit cards. They tend to be a bit debt averse as well. They're not using these simply because they want access to credit. They're using these for other reasons, partly because they're providing a good payment experience online. In terms of the potential for future growth in buy now, pay later, Australia is seeing a very similar trend in terms of both awareness, which is the top chart, and usage on the bottom chart. Key difference here is that in Australia, this is almost completely driven by Afterpay. So awareness of buy now, pay later, awareness of Afterpay is much, much higher than any other buy now, pay later service in the market. Whereas in New Zealand, you sort of have Afterpay and lay-by sort of splitting that to an extent, and some more providers who also have higher share. When we track awareness of buy now, pay later in New Zealand against the Australian example, you're almost 6 to 12 months behind, which suggests that there's potential for awareness to increase to that sort of 60% mark, perhaps over the next 12 months. Similarly for usage, so in Australia now seeing 19% of consumers having used a buy now, pay later service. What we're trying to grapple with a little bit here at RFI is where's the ceiling with this? Where do we start to see this plateauing off? Or are consumers going to continue to use these to a greater extent? Other key point here is that when we're looking at the types of transactions that have been made by the likes of Afterpay, or using the likes of Afterpay, they're typically low-value transactions. So the average purchase, consumers tell us, when using Afterpay is around $150. So they're not these massive transactions that suggest consumers need access to credit. And when we ask consumers why they tried using a buy now, pay later service, the primary reasons are that they could make better use of the money if they weren't paying for the whole purchase up front, and to help me budget. It's not because they didn't have access to credit, it's not because they were denied a credit card. And actually, as I said before, these younger consumers typically don't have a credit card and also do tend to be a bit debt averse. The other point here is that they're using buy now, pay later because it was easy to set up. So that having that easy experience is helping to drive usage of buy now, pay later. There's another question we asked consumers in New Zealand trying to understand what they thought of services like Afterpay. And we gave them a description of what Afterpay was and then said, in your mind, what is this most similar to? Most consumers, in particular older consumers, said it sounds like a traditional lay-by service. followed by a credit card or a line of credit. For millennials, around 20% said it sounds like PayPal. It sounds like something I check out with. I check out with Afterpay like I check out with PayPal. To consumers, this isn't just about credit, it's about a payment experience. And I think if there was less friction perhaps in online payments, you wouldn't see these providers doing as well. They're also struggling in the in-store, for in-store payments because there's so little friction there already, and having to set up an Afterpay account while trying to check out in-store is difficult. And then lastly, I wanted to talk a little bit about open banking. So as I mentioned, we've just run a study in the UK looking at consumer perceptions around open banking and PSD2. We're running one in Australia in the next couple of months. And starting to look here at both what consumers feel about giving up their data, who they feel comfortable giving their data to, and what they expect in return. An important part of that goes back to trust, which we've spoken about a lot over the last couple of days. We've asked this question globally, so this is our global average, for a couple of years now. To what extent do you trust different providers to hold and maintain the privacy and security of your personal financial information? At a global level, 42% of consumers say they trust their banks. And that trust there is an 8+ out of 10. 31% said they trust the government. That changes a lot by market. 28% said they trust a technology company. And technology company here was Google, Apple, Facebook, or Amazon. You can probably tell from that figure as well, this is pre-Cambridge Analytica. So we're expecting that Facebook's going to decrease here, or that technology companies might see an impact there because of Facebook. When we've split them out before, consumers trust Amazon to a much greater extent than they trust Apple and Google, and Facebook is a lot lower down the list, especially at the moment. But the point here is that the trust in technology companies is actually catching up to trust in banks. So over this 2-year period, trust in banks increased by 10%. Trust in technology companies increased by 14%. And when we look at this by age, millennials trust technology companies almost to the same extent that they trust banks. Trust in banks is increasing globally. So you can see from that trend that it's going upwards. It's going upwards in every single market that we ask this question in, except for one, which you can probably guess is Australia. So in Australia, we're seeing trust in banks decreasing, but it's actually been decreasing since the second half of 2015 when we first started asking this question. And the rate of decrease of trust in banks hasn't really changed, which suggests that the Royal Banking Commission isn't the only reason why we're seeing decreasing trust in banks in Australia. The other point here is that while consumers might say they trust or distrust some of these companies, it doesn't always match up with what they do. So we've also asked consumers, they also don't know what they do. So we've asked consumers, do you share your personal data with anyone? With any apps, with any services that you use? Significant proportion said, no, I don't. We then asked, do you use these types of providers? Netflix, Apple, Facebook, Amazon, Google. The overwhelming majority do. They don't realize the extent to which they've already given up their data to a lot of these providers. So while banks have the advantage of trust, consumers don't necessarily understand what's happening with their data already. So moving on to open banking specifically, and the challenge that we face with how do you ask consumers about open banking when they don't know what open banking is? The way we framed it up was open banking is new legislation, could be introduced in some countries, designed to increase innovation and competition, and it means that third parties would have access to your financial data. Benefits include having access to more tailored advice, being able to view all of your banking products in one space, having product recommendations given to you. You need to consent to give your data in this way. Would you be interested in consenting to giving your data in order to access these type of services? In Australia and the UK, so the two markets where we're sort of close, or the UK has open banking, Australia, one of the markets where we're closest to open banking, around 20% of consumers said, yes, I am interested in this, I want to know more about it, or I'd be interested in giving my data in this way. An additional 40% said, this sounds interesting, but I need to know more. Just 20% said, absolutely not. And when we look at this by By age, younger consumers are much further towards this right-hand end of the screen, so significantly more likely to say, I'm very interested in this. Baby boomers, significantly more likely to say, I'd be very hesitant to sharing my data in this way. So quite polarized. The other point there is that younger consumers also, while being more likely to share their data, trust providers other than banks, and are more likely to be using those types of services where they're already giving up their data. So who would consumers in the UK be willing to provide their data to? So how likely would you be to give the following access to your personal information? Mostly consumers trust the banks, so most consumers would be comfortable giving the banks their information, followed by PayPal. So PayPal's maintained this perception of being very secure and very trustworthy. Google, Apple, Facebook, and Amazon fall a lot lower down that list, so just 12% would be comfortable giving them their information. Fintechs are lower than that again. We also asked a follow-up question here, which is why wouldn't you be comfortable giving your data to those different providers? So those who said they'd be uncomfortable giving their data to banks said that's because, well, banks already know enough about me. Why should I have to give them any more information? When we looked at comfort with giving data to the likes of a comparison website, the concern was they're going to use my data to sell me something. When we asked consumers why they wouldn't want to give their data to someone like Google, or Apple, or Facebook, primary concern was, I don't know what they're going to do with my data. I don't trust them to keep it secure. Banks don't have that same perception, which means consumers are going to be more willing to give the data to the banks. Which brings me on to this slide. So looking at if consumers were to give their data to a third party, who would they expect to be responsible for that information or for the security of their personal financial information? Overwhelmingly, consumers expect that their banks would be the ones who would keep their information secure. We asked a follow-up question, which was, who would you call if something went wrong with this service? And the results are almost identical to this. So for traditional providers, consumers trust them more than other providers. They don't have those same concerns around what's going to happen to my data, how are they going to use my data. They're also who consumers are going to turn to if something goes wrong with a service provided under an open banking-like environment. Which means that there is an opportunity there for traditional providers to innovate and to provide services that aggregation is probably a key one, that consumers are already interested in. The challenge is if they don't, and a fintech does, and a fintech comes into the market with a service that actually does meet some of those consumer needs or existing consumer pain points, banks are going to still have to do a lot of the heavy lifting in the eyes of the consumer. So wrapping that up, and just to leave you with a sort of a couple of key thoughts around what we're seeing in terms of these global trends. We can expect the contactless card usage will continue to increase in New Zealand. It still meets that consumer need of having an easy and pain-free payment experience in store. Buy now, pay later is disrupting online. However, because of that, creating an easy checkout experience and meeting that consumer need around budgeting as well. Mobile wallet usage, however, will likely remain low unless there's a proposition in the market that does more than just offer you a means of payment. In terms of open banking, consumers do see some value in it and are open to learning more about it. The opportunity is probably there for the traditional providers. And this has been touched on a lot, I think, over the next couple of days. Traditional providers have that opportunity to be the first movers. If they don't, potentially the challenge there becomes who will consumers be using instead of their primary provider for a lot of these services. Buy now, pay later does show us that if someone comes into the market with a good proposition, something that's easy to use and meets that consumer need, for buy now, pay later around budgeting, there can be disruption in the market.